All right, welcome back. We're going to cover chapter 11, which is industry analysis. We're going to talk about the influence that industries have on the individual companies and on the stocks in those industry groups. All right, industry analysis. So we're continuing on. Let's see, here we go. We're continuing on with top-down investment analysis, starting with the global economy, and then moving into the domestic economy, and then going into the stock market itself within a domestic economy, and then inside of the stock market going into industries. Now, I want you to keep in mind that there are sectors inside of the stock market, typically 10 or 11 sectors, and then within those sectors, you have individual industries, and then within individual industries, you have individual companies and their stocks. So we're looking at industry analysis. All right, so next step, industry analysis. What is industry analysis? Well, it is the study of the conditions in each industry and the structure of each industry and of the influences exerted on the individual firms and their stocks, and by the conditions and the structure that characterize the industry. So what is the condition of the industry? What is the competitive structure of the industry? And how do these things impact the companies that operate in the industry and the stocks in the industry? All right. Why do it? Well, studies show that there are significant disparities in the equity returns of different industries over time, as it is the case with different economies, different stock markets, different asset classes, stocks, bonds, commodities, real estate. There are different styles, growth and value, different sizes, large and small. Returns vary among these different investments over time. We want to build a diversified portfolio, and so we need to look at many different industries to include in our portfolios. Some industries show substantial cohesiveness. That means that many of the companies are very, very much alike, and they face the same variables and factors and conditions every day that they operate, and their operating financial performance is similar because of the factors and conditions that they face, and their stocks tend to move in lockstep, very close together. And just to give you some examples, the natural gas industry, the automobile industry, the railroad industry, there are many, many examples. The semiconductor chip industry, the steel industry, many, many industries really move together. The companies and their stocks all work together. It is estimated that 10% or so of a stock's return is due to the industry influence, but I would tell you that it is much higher for many industries during many periods of time. There are periods of time when industries, for extended periods of time, really, really move together. And so it's very difficult to break out of that industry pack and to throw off the influence of the industry, because all of the companies in the industry face similar conditions and factors, and so it's hard for one stock to swim against the tide. Just like it's difficult for a stock to go up when the market is going down, it's difficult for a stock to go up when the industry is facing tough times. Okay? What is the objective of industry analysis? Identify industries that have superior stock return potential. Make money. So we're looking for industries where maybe conditions have not been great, but where conditions are improving, where valuation doesn't look great, and expectations are low, and so possibly we can take advantage of that and get in before the big move up, and get out before the big move down. Okay? All right, so let's take a look at the industry life cycle. This is the kind of table or chart that we see for a lot of different applications, okay? But let's look at it in terms of the industry, the industry life cycle. All right, industry sales and the level of trends in profit margin. What happens to sales? What do profit margins look like? What does competitive structure look like for these industries? So we'll divide the development into stages, okay? Each stage does have discernible characteristics. You can tell which stage we're in based on what the rate of growth of sales looks like, based on the trend in profit margins, based on the intensity of competition, the type of competition. We can tell what stage we are operating in, okay? The transition from one stage to the next stage and the duration of each stage, these things are very difficult to forecast. So we know it when we see it, but it's difficult to forecast it. All right, so this is the curve. Looks kind of like, a little bit like a yield curve here. All right, so this is time and this is sales. The y-axis is sales and the x-axis is time. Okay, so stage one, pioneering and development. This is the first stage in the industry life cycle, the pioneering and development stage. The second stage is the rapid or accelerating growth stage. Third stage is the stabilization and market maturity. So we've got this inflection point where things really pick up, and then things tend to kind of even out, stabilize, and then deceleration of growth and even decline, stage 5. Whoops, we're missing a stage. I guess this is 1, 2, 3, and 4. I'll have to fix that, but not now. Okay, so let's look at the pioneering stage, pioneering and development. What does the industry look like during this first stage? Well, first of all, sales are low because the products and services are new, okay? And the sales prices of these products and services, typically at the beginning of the life cycle, the prices are high, okay? You think about the electronics industry, for example. You may not realize this, but when VCRs were first developed, they were over $1,000. Now you can get a Blu-ray for $50, but they were over $1,000 when they first hit the market, okay? Products and services have to be fine-tuned in order to meet market needs. So the products and services are new, they're introduced into the marketplace, and companies are still trying to figure out exactly what the market wants, okay? New industries usually lose money initially because the development of these products and services, the cost of developing very high, and a lot of money has to be spent to inform the public that these products and services exist. And at the same time that they're spending this money, the sales are low. All right, then we enter phase 2, stage 2, rapidly accelerating growth, okay? This is where industries really begin to reap the benefits of their efforts. Competition is still relatively limited. There are not many other firms out there that are trying to offer these products and services because the products and services haven't really been mass marketed. They haven't been accepted by the marketplace in mass. And so competition is limited. And because competition is limited, pricing and margins can be high, and that's a good thing for business. And sales and earnings growth in excess of 100%, pretty typical because you're working off a low sales base, and there's a lot of market share out there that is to be captured, so companies can grow very rapidly their sales and their profits. Then we reach market maturity. Oh, looks like we're out of order here. So the high sales growth, high profit margin begins to attract competition. That's capitalism. Sales growth goes from 100% all the way down to 3 to 5%. Okay? Profit margins will peak, come down a little bit, stabilize typically, okay, and at a much lower level because competition heats up and competitors battle for market share. Okay? But because of the expertise of management in developing and executing strategies, profit margins among individual companies can really vary. So this is the stage where management, professional management, can be really, really important. Can you manage your company in a competitive environment to maximize market share and to maximize your profit margins? Okay? And this is typically the longest stage in the cycle, the stabilization stage. Then finally we get to deceleration and consolidation. Okay? So sales and profit margins decline. Okay? Companies have peaked out and they're on their way down a little bit in terms of sales and in margins. Substitute products have been developed and provide even more competition. Okay? Too much industry capacity exists given the number of competitors out there and the amount of market penetration that has happened and the substitute products that are out there. So typically there's too much capacity and firms in the industry go out of business. They are purchased or they simply go out of business. Okay? And then what happens? We start over with another industry. All right, so that is the industry life cycle. So we're going to take a breather right there, and we'll come back and finish the rest of this very short chapter 11 on industry analysis. Until then, shalom, peace out.